Good morning, everyone. Wanted to welcome you to the seventh final installment of our summer speaker series. This one is new capital flows with a renewed interest in the federal market. I would say more of a private equity focused panel. And really, I think as we look at the changes in the environment, we'll probably take the concept of the title a little bit further than that, and look at what's happening in the investment world today. So let's set the stage a little bit. By any number of benchmarks in the deal and economic communities, 2021 was a banner year. The stock market soared to one of the new all-time highs. I think deal flow by any metrics was huge. You look at 2022 in the first 6 months, it's proving to be a different story. The S&P 500 closed out the first half of the year down nearly 21%. This is the steepest first half loss seen in more than 50 years. June saw more worries in key inflation indicators after prices have continued rising at the fastest pace in decades. And the Federal Reserve, reacting to that, is ratcheting up aggressively on interest rates to try to tame that inflation. Globally, the supply chain issues stemming from COVID-19 and disruptions from there continue and are even worsened more by the ongoing war in Ukraine. All of this has continued to increase the worries about recession and whether or not it's here or it's still coming. There are headlines with obvious direct impacts in the public markets. Viewing those as a barometer for the private equity investor, the panel we have with us today, and the M&A environment is really where I want to dig in a bit. So we have three leading professionals from private equity with us this morning, each with a different focus and varying strategies within their firms to share their thoughts. So I'll introduce our panelists and ask them to give us a quick overview. First is John Allen with Bluestone.
Good morning, Paul. Thank you very much, and appreciate the opportunity to be on this morning. And Bluestone, by way of quick background, is a private equity firm focused on investing in lower middle market companies in the defense and government services sector. I think your title was renewed interest in federal government. Ours is just a lifetime or sustained interest in the federal government marketplace. So that's really what we're all about, is sector focused fund, lower middle market, which is starting with businesses in the range of $50-ish million, and then helping them build through M&A, as well as investing so they can grow organically too. So that's a brief background on Bluestone. Look forward to participating this morning.
Great, thanks, John. Next, we have Chanana with Gemspring.
Awesome. Thanks, Paul, and thanks for having us. Rob with Gemspring Capital. We're a lower middle market and middle market, I suppose, private equity firm based out of Westport, Connecticut. Founded only 6 years ago, so renewed interest or new interest. We're still very, very new, I suppose, in the grand scheme of things. We invest in assets between 5 million of EBITDA up to 75 million of EBITDA, and we're currently investing out of our second fund, which is a $785 million vehicle from an LBO perspective. And then interestingly, we also participate in minority and structured opportunities. So we see a lot of founders and a lot of tricky environments that have been transpiring since COVID particularly, but especially in this current environment where a founder isn't really sure that they're ready for a majority sale. And so we raised a separate pool of capital to support them in the evolution of their business in a minority transaction. In any event, we're about 40 professionals in aggregate. We're industry agnostic with a service kind of slant. So each of the senior deal team members have a particular area of business services. And then I also have aerospace and defense, given my background, has 8 years of GE experience, including time at GE Aircraft Engines based out of Cincinnati. So appreciate the time and thanks for having us.
Great. And then finally with us this morning is Chris Cathcart with Halifax.
Thanks, Paul. Good morning. Halifax, on the other end of the spectrum, we're 22 years in investment history, currently investing out of our fourth committed fund. We define our focus as squarely in the lower middle market, so focused on entrepreneurial and management teams and founders, come alongside them to partner with them as they think about that next stage of growth. Typical size of businesses we'll invest in, generally from a revenue perspective, about $100 to $250 million revenue, and commensurate sort of profitability that goes with that. We have maybe a step in between my two fellow panelists here. We're not quite a sector-focused fund, but primarily focused on outsourced services, including government services, health and wellness, and then we do also invest in a unique model in franchising. So we'll combine those efforts to deploy a fund over the course of 3-4 years. So that's the Halifax background, and thanks for having me.
Great. Thank you, everyone. So 3 professionals, 3 slightly different focuses on the market. Excited to kind of get some different perspectives on how we look at things. And John, maybe I'll come back and pick on you with the first question, but Rob and Chris, please jump in with additional thoughts. In my little preamble there, we talked about the rising inflation. We talked about stock market volatility. We talked about major geopolitical factors at play in the marketplace. Comparing that to 2021 and perhaps the year or two before that, and where we are now in 2022, can you provide a sense of what has changed from your side of the table in making investment decisions?
Well, again, because of our sector focus in the defense and government services marketplace, has a history of kind of being kind of counter-cyclical. So, maybe it looks a little bit better when the rest of the world looks a lot more volatile. We kind of feel that that's the situation at the moment. Really, though, it's a well-established market. Defense budget alone is $750 billion. It's its own economy. Then you have the civilian agency spend, which is a similar amount. And I think there's things that don't change despite all the volatility. And that is, you need to grow. You need to be able to offer more capabilities in mission critical areas to your customer base. M&A has been a tried and true strategy amongst the bigger players in the marketplace. And so it's now trickling down, if you will, to smaller companies. Certainly our model is participating in that we're trying to invest in the lower middle market companies and help them not just rely on organic growth, because that's a little slower. It's great. It's the best way to grow, but it's a slower way to grow. You can position yourself better for accelerated organic growth by participating in M&A. And so we think that, look, defense budget's likely to go up. We're probably on the front end of a big build out for defense. So you're going to take a big marketplace, make it bigger. The things that you need to do is just be sure you're investing in growing your business in areas that are mission critical. And you can kind of see that there's a lot of transparency in the defense and government marketplace from a budget standpoint. And you can also see it simply like when the government shuts down during budget battles. Well, you have companies that have 100% of their workforce that still shows up to work. That kind of implies they're mission critical. Or you saw it during COVID when, there were certain companies that no matter what, the customer wanted them working. And that another sign of mission critical. So if you stick to where the priorities are, you keep trying to grow your business so you can offer more to your customer, I think you can put some of that volatility that frankly is outside of our control, in a box and keep doing the right things and build your business and build value along the way.
Chris, I'd be interested in your thoughts here. I think coming from the more of the outsourced business model focus with healthcare and franchising thrown in, there's probably a number of different ways you look at it aside from John's aspect of liking volatility.
Yeah, I think certainly, I think we've always had a very high level of sensitivity to cyclicality in whatever end market we might be studying. We're sort of thesis driven, so we'll pick a sector and validate an investment thesis and then go look within that sort of pool of available companies. And certainly probably on a normal circumstance, the first 2 questions are going to be, how does the sector respond in a cycle? Given where we are, we'll probably add the 3rd question would also be cycle exposure. And so that's certainly a high level of sensitivity there. And then we are looking the next step further. It's been a long time since we had an inflationary environment. So looking for models where you can have pricing power with your customers. So I think that's a parallel to what John is talking about there, that mission critical aspect, mission critical to your customer, whoever it might be. That will imply, we would hope, some pricing capability and power. And there are also certainly models that allow for repricing more regularly, so you can stay sort of ahead of this inflationary trend that we've had. So that's that 1-2 punch of inflation and cycle risk certainly is weighing our investment decisions, and certainly will continue, I think, to be the first, second, third question as we think about both the sector and a particular company from an investment perspective. So it's certainly certainly on top of mind, and if you were to look at the various sectors we're focused on at any moment, you'd see some a consistent theme there of recession resistance.
Great.
Yeah, only to add, I think it's actually, you go back 3 years and go, what were we debating around the room? The world was so good. Assets were only moving up in valuation. Multiples were only moving up in valuation. It was hard to see a dark cloud, right? And so the question was like, where's it going to hit? When's it going to hit? The last 24 months, these companies have taken blow after blow after blow. And these leadership teams have had to succumb and figure out, right, how to block and tackle their way through COVID, through being a PPP, getting credits, surviving, finding talent. Now the war on talent. Now you've got recession talks. You've had pricing inflation. You've had supply chain issues. Yesterday, it was good to have a non-US supply chain. Today, it's not so good to have a non-US supply chain. You actually have so much more data on these assets and the measurement of durability on these leadership teams. In the last 24 months, you've had more than you've had the prior 5 years, in my opinion. And so you actually have an easier kind of decision-making process around what do you think is going to happen in this asset based on all you know? The big question is going to be, what have I not figured out, right? Because could not have predicted the last 2 years the way they were, but you have a lot more data and you have a lot more measurement of how that leadership team today performed during that level of uncertainty. And I think that's an interesting lens of looking at it going, how much worse could it really get, perhaps, right? Things can change, the environment continues to evolve, but these teams have been through a lot. These founders have been through a lot in the last 24 months. And that's actually, I think, an advantage as you're making an investment decision around evaluating all that they've been through. A little bit harder to do that a couple of years ago relative to today, in my opinion.
Yeah, Rob, maybe building on that a little bit, and with Gemspring having a little bit of a broader mandate than Halifax and Bluestone, what are you looking for in the current market environment? You've talked about these managers and what they've done in the past. We've obviously got these new issues you've profiled going forward. Are you looking at that management team? Are you looking at the business model? Are you looking at a specific sector? Or are there things you're looking to avoid?
Yeah, there's probably less on the avoid category. There's always a price, right? And the question is, how much can you discount the price relative to what you believe intrinsic value ought to look like, right? And ultimately, I'd say, the baseline for how we underwrite transactions, how we evaluate transactions as a committee, how we invest hasn't changed, right? So we look for fundamentally strong, good, durable businesses that have a real reason to exist. And if they've evidenced that over a series of time, and especially in the last few years, in the most difficult period of time, the ability to retain customers, grow their customer base, cross-sell their offerings, if they're really lucky, expand vis-a-vis M&A, and show a path for multiple ways to grow. And if they've done that really, really well, run after them all day long. The reality is that's not every scenario, right? And there's risk appetites that differ, there's performance, there's subsector micro decisions that were made. And, if you can get your head around enough of that base business being truly valued, the question is, what triggers can you pull based on that leadership team not having all the decision-making ability, not having all the same risk appetite, not having the same capital and balance sheet to do capital allocation at that level. And, as a result, Gemspring takes probably somewhat less of a thematic. We're more of a probably hybrid opportunistic plus a thematic view. So each of the senior team members have a theme or two that we're pursuing at a time. And then we have sort of a worldview that, for good or bad, you can't kind of force who's going to sell, right? And so you have to evaluate that marketplace when it's happening, and be thoughtful in that moment of time. And so we try and sort of marry the two, but that's a harder balance to do. That's kind of how we think about the world. It's not run away, it's run towards, and price in what you think is uncertain as a result of continued volatility versus less. And I think the easy thing you can say is you step back and go, is the world going to be likely, is the consumer, is the business world more bullish or less bullish than last year? And it's obviously bearish, right? And so you're pricing that in, you're pricing that volatility in versus being better than last year.
Great, thank you. Chris, jumping back over to you with kind of a slightly different industry focus. As you look at the current market climate, are there any interesting specific investment thesis you're looking for? Is there something in the current environment? And I think John touched on this a little bit. Government is kind of counter-cyclical, and this is really an interesting time for some of those pieces. But that you could have the same argument with something like cybersecurity and its growth over the last 10 years. Is there anything from the Halifax perspective that is really more of an interesting thesis for you right now?
Yeah, I think those are certainly, government services would be certainly a sector you'd look to and look to be able to perform and be steady through an otherwise with the other macroeconomic uncertainty that we've got. I think there are other sectors, certainly within healthcare, although the challenge in healthcare has been a little bit of the opposite. You've got to avoid something of the flight, to capital there, and find places to avoid maybe being run over by the stampede in some of those areas, because it's certainly an obvious answer. I think there are other sectors, though, related. There's a theme here with the end customer being the same through healthcare and government services. There, in many cases, you've got a government customer. Similar to that would be education. You'd certainly look to some education sectors, and they will have countercyclical properties as well, assuming that this recession, if we're having one, follows others with softening in the labor market. You'd see folks look to continue their education or enhance their education. So I think some of those themes are certainly prominent and would reappear and be, I think, interesting to us in an environment like this. So those are a couple thoughts that come to mind.
John, from your perspective and kind of the same topic, same area, your government contracting, you've told us is a great place to be right now, but there's 10, 12 different subsectors within that. Are there any specific areas in that kind of definition where you would want to focus more, or you would look to shy away from a little bit?
Absolutely. I made the point it's its own economy, and Chris was walking through kind of verticals that he might look at to invest in. I think you can have derivatives of those kinds of verticals in the government space. You can make a health-related investment in a government, purely government contractor focused business. You can do technology, gov tech. You can pretty much, if it's done in the commercial markets, it's largely done in the federal market. It's just how you go to market and who you're marketing to is different. And maybe there's some less volatility, although there's a lot of nuances and a lot of challenges to operating in the defense and government market if you're not in it all day, every day. So we definitely have themes. We have 5 businesses in our second fund portfolio, and each one had its own theme, from geospatial data analytics on down to affordable housing, and in a number of things in between. So when you start at our size, the companies can't be all things can't be all things to every customer. So they do need to have a bit of a niche, and that niche, as I talked on earlier, probably needs to be much more mission critical versus administrative and things like that, where when there are budget challenges, and you can have a growing budget environment in the government space, and you can still have budget challenges because they don't pass budgets on time. You operate under continuing resolutions, so you still deal with your own type of uncertainty. So we are looking at things that, to overuse a term, that are essential or mission critical first and foremost. and where there is more favorable growth dynamics in a very large budget environment. Defense will obviously be a big part in various elements of defense. But one area that maybe you don't hear as much out there is on the civilian side. We had a business, as I mentioned, that was affordable housing focused, 40-year-old company. We have a housing affordability crisis out there. It's not going away anytime soon. It's an essential service that they were providing to maximize the amount of access that was available for affordable housing. So we will look for businesses like that. I'll call it a citizen essential services platform that will have nothing in the defense marketplace. So it's a big sector, lots of paths for us to go. At our size, the goal is to build differentiated businesses in a variety of subsegments of that very large defense and non-defense marketplace.
So staying here, kind of building off of this question. Earlier, you talked about growth and organic versus acquisition opportunities out there. We broadly look at your portfolio. Not picking on any one name, but do any of these parameters, the global parameters, the economic parameters, change your perspective on plans for the current portfolio companies?
Happy to kick it off.
Go ahead. Yeah.
Oh, sorry, John. Please. Yeah, I'm happy to kick it off. I suppose we've got 22 portfolio companies across our current funds, and I'd say the conversation's obviously elevated in terms of what do we think could happen. But I think the opportunity in the field for what could happen actually just gives us more options. And the fact that I think all of us have the luxury of a fund that can back these assets that have built resiliency, that keep emergency buckets in the event you need them. But that two, most of our stuff is backed by direct lenders who also have more flexibility than ever before. And that's probably the biggest change from the last set of crises, right? These direct lenders that support all of us and what we do from an LBO perspective are actively looking to support their portfolio companies as well. And I think there's just a lot of liquidity still available, generally speaking, to support well-backed, capitalized assets. And I think that's an opening for more. And I think the risk appetite, therefore, especially in the lower middle market, when you've got founders who have been through the last 2 years again, they felt a lot of stress and a lot of pain. And I think you're going to see more opportunity there from an add-on perspective as a result, because how much more do you want to go through? And I think I think that's allowing more interesting dialogues around both add-ons, merger of equals, and just seeing that opportunity set. But I'd argue financing, liquidity, M&A are going to remain robust. And I think there's just a broad difference in how everybody thinks about the liquidity from a portfolio perspective, and two, the direct lending environment is just very different today.
John, anything to add to that?
I think that that covered much of it. I think I agree. I'm sure it's across sectors. I only know one, so I sound like a broken record. But I mean, M&A works in the defense and government marketplace. You just look at the leaders out there. Carlyle Group announced the acquisition of a company called Mantech. Mantech probably made 30, 40 acquisitions in its history and built a lot of value. And so I think that it's the leading players in the market. It's part of their operating culture to do M&A. There is a need to get bigger to serve a very large customer. And so M&A is a key tool for that. And I think that we just need to see lower and middle market companies participate more actively in that. And that's where partners like the three panelists here can bring to the table, which is capital, M&A expertise. It's hard to have that M&A expertise in-house all day, every day when you're a small company. So you partner with somebody like us, and they bring you that expertise in addition to the capital. And you're in an environment in a sector where it's an important tool, and it has a long history of working well for both strategic, operators in the industry as well as private equity backed businesses. So I think we'll see M&A continue to be a big part of our marketplace. And I agree, plenty of capital out there to support those activities.
Chris, I'm sure that there's direct changes to that comment if we look at the franchising world, but any changes you would say from the healthcare aspect or more of your traditional outsourced business model?
No, I think, listen, I think two comments. I think from a market perspective, I think, listen, I predicted this year coming into the year that we would, from an M&A origination perspective, we'd have a year that looked a lot like 2019, which was to say 2020 was an outlier and so was 21, and that we'd return to sort of a more normal but high volume kind of year. And I think the first half of the year proved that true. Our data show that. I would suggest the back half of the year and probably into next year will be slower. I do think, and go back to where we started our conversation, I do think I'm hearing, and Rob alluded to this too. If you have to ask bankers a couple questions. They'll tell you they're busy and they've got lots of backlog, but if there's an industrial asset with obvious cyclicality or a consumer asset with obvious cyclicality or exposure, it's probably not coming to market right now. So I do think there's going to be a volume reduction here in the back half of this year and probably in the next year. But I do think the capital availability is there for assets that have this mission critical capability and a demonstrated ability to grow, and I think that'll still be available. And then I think as regards to our portfolios, though, I do think there'll be a lot of opportunity for investors who can create value during their hold to shine in this market, whether it's M&A or organic platform building, the things that support this kind of growth trajectory. I think it's the Buffett line, right? When the tide goes out, you find out who's been swimming naked. And I think if we've had a kind of 10, 12-year run of ever expanding multiples, that's been a great way to make money. But I think if we think higher interest rates and a little bit more value orientation in the marketplace will level those out, we'll see if that's true. You're going to have to be able to create value in other ways. And I think that's where investors who have that ability and that thoughtfulness about how they create value in the portfolio, I think that'll be rewarded in this environment.
How does a firm such as yours or Bluestone and Gemspring think about the same aspects from a liquidity standpoint from the current portfolio companies you have, and should we be looking at new financing alternatives? Should we be looking at a liquidity opportunity? Obviously, we can be constrained by fund lives and other issues, but you want to capitalize on a business at the right time. So what changes in that perspective?
Well, I don't know if I have a very thoughtful answer to that. I do think that we'll see from a balance sheet perspective, I think you'll see some sponsors moving quickly this year to refinance balance sheets. Anything that's approaching that 4 or 5 year horizon, I think you'll see sponsors begin to think about that window. I agree with the other panelists, though. Frankly, I think credit availability is very strong, and I would suspect it's going to be attractive to investors. So I suspect that capital availability is going to continue to be strong, but we'll see increasing costs. So I think you'll see sponsors looking to shore up balance sheets and make sure that they're well capitalized if the exit window is, as I'm predicting, may not be as available to them.
Would that be more in terms of financing the business, or looking at taking some dividends, some cash out of the business through the credit markets?
Both.
John, Rob, do you agree, disagree?
Yeah, look, I agree. I think that the sentiment is going to remain that, if you believe the valuation compression in the industry in which your asset exists is temporary, then you're taking a balance sheet related capitalization change, right? And there's no reason to sell. That's the beauty of a hold. That's the beauty of continuation vehicles and SPVs. It's the It's the why sell now when you know that you're leaving dollars on the table. If you believe that fundamentally that industry is forever impaired relative to where it was, or that level of euphoria is never coming back, that's a different equation to me. I think we sit back and kind of think about very simplistically, because one, we're not playing in the market where I'll post-mortem 4 years from now. My guess is the majority of our portfolio is never going to be hold, period. And so, the public markets are less, I'm less sensitive to the movement of a public market. And so I step back and go very simplistically, am I support a portfolio company in its development of its life cycle to drive enterprise value? If over time I am up and to the right, that's what we're all fighting for every day. It's not perfect, it never will be, but if we're driving enterprise value, it's attractive to somebody else. It's likely going to be. Again, not going to be perfect and won't be the right ups and downs, or some stuff lumpier than others, right? But inherently, step back and go right enterprise value things over a longer sustained period of time. If so, it will be attractive to a broad swath of individuals, be it strategic, be it other sponsors, maybe a public market exit, but that's in our situation less of a likely outcome. So kind of goes back to the broader, there's just a ton of liquidity, even at the private equity sponsor level, that there's an insatiable level of demand from that perspective, right? So quality assets will continue to get quality valuations as well, in my opinion.
I'll just add, in the defense and government marketplace, I've talked right about M&A as an important tool used by many of the larger players to continue to grow their business. So there's a lot of buyers. And then you also have kind of emerging or increasingly active buyers that are the non-traditional buyers that, the Wall Street and the financial community might not call them a government contractor, but they have a significant presence in the government market. And over the last couple of years, they've increasingly seen it as a sector they want to invest in, and even more so now as the growth dynamics might be a bit more favorable. And then you have a lot of private equity that have participated in back platform companies in the defense and government market. Tends to be larger, right? So the challenge is and maybe the good news for certain sellers, there's not enough businesses of size in the right areas for the many acquirers that exist out there. A little bit of hence our model, right? Start with the smaller companies, do the heavy lift that maybe the bigger buyers don't want to do, to make them a bit more attractive and well positioned to attract that larger buyer, and kind of capture a size premium as you go. So I think we have a dynamic of a market where a lot of participants think M&A works. There's a diverse range of buyers. They're certainly well capitalized, as everybody's talked about. They generate a lot of cash flow in addition to having access to financial markets. But there's a lack of medium-sized or bigger assets. So that I think will help keep valuations attractive for companies in the marketplace.
So we've touched on to be what is one of the most common topics in any deal. Any business owner, any private equity firm, looking at opportunities, valuation. We've had a huge run up, economic boom over the last decade. Valuations have hit, you would have to call it historical highs. And now we've had a pullback, down 20% in the S&P over the year. Obviously, that's a barometer, to Rob's point, not necessarily the full driver in valuations, but a barometer in how to look at valuations. So now you have business owners looking for those superior multiples, and private equity firms looking for what they view as the right fair market value. How do we address these? How do we as private equity investors address these differences in looking at new opportunities? Rav, maybe I'll start with you on that question, since I'm giving you credit for bringing up valuation.
Oh, sure. Look, I think it's a little bit both sides, meaning those representing sellers, I think, need to help a founder understand the market's changed, right? And the valuation of trying to get a valuation from 2021 is behind us. And I think that's a hard pill to swallow for a lot of folks, but that's the reality of the situation in many cases, not all, of course. And I think the pendulum that's pulling the other side is just the amount of capital that needs to be deployed, right? That's kind of keeping valuation levels at an elevated level in some cases, right? And the two will converge, right? That Venn diagram will come down to a level. But I think that's the reality of it. Is people need to hear, hey, my friend didn't get that valuation, right? My friend's deal from last year, they couldn't figure that out or sign it, and it's different today. That's the chatter that creates the uptick in the smaller, in my opinion, the lower middle market. Is I heard from a friend of a friend, they sold their business, they did Y, I want Y plus one. That'll take time, but that'll compress, right? And I think that kind of the intermediary broker, banker helping in the middle to level set expectations will change that dynamic. And two, to a little bit of what I started with in terms of our introduction, there's a particular reason why we introduced the structured equity fund. And taking minority positions gives a founder a chance to not have to sell a majority stake. And if we believe that driving enterprise value of this business will occur over the next 5 years as well, and there's a chance for a rebound in enterprise value and terminal value, that from a multiple perspective, why sell 80% of your business today? And so we that's why we added that as a product in our toolkit to approach a situation in that manner and allow for the flexibility of a minority deal, to allow for the upside to be more obtained by the original capitalization table, the founder, whomever, over the hold than a majority sale today. And so I think just more flexibility, a willingness to think around the edges, and I think some help along both sides of expectation setting will eventually drive kind of a convergence. But
Chris, I'd love your thoughts on this before I ask John, because John's just going to tell us valuations are going up because this is a great market for government contracting.
No, I think Rob said it very well. I do think we'll have to have a reset of expectations, and for the vast majority of businesses, the right tail assets will continue to drive and command premium prices. And I think actually we're looking at a data set recently. I think the data continue to show that businesses with above average characteristics are going to command. Last that I saw was a 30% premium. So above average margins and above average growth rates, you're going to continue to see capital flowing to those assets. The real game though will be the fatter part of the bell curve, which implies more GDP-like growth businesses that probably are successful, good, strong, solid businesses and the vast majority of businesses fall there by definition. Those businesses will be valued at maybe X minus one. We'll use generic terms there, and I think everyone's just going to have a new expectation set. But the reality of it is, and this is maybe the only thing I would add, is as you're counseling your clients as an advisor and other advisors, counseling their clients and the expectation of valuation at the first exit or this first capital infusion, choosing your partner wisely, right? Talking to folks that have a vision, a shared vision on how to create value during the hold. I think now we've probably said that 3 or 4 times. That's going to be the coin of the realm, I think, going forward is how do you create value during your hold so you're not beholden to an ever increasing or ever expanding market.
So John, defense spending's going up, volatility is great for your area. Valuations, what are we going up? 1, 2, 3 turns?
Well, I don't going up. I might not say that. I think to maybe I think something that's talked about, and you started out your intro to this with what's gone on in the stock market, right? And looking at the broader indices and look at the tech sector, right? There's many tech companies down 60, 70%. The biggest and the best down 30, 40% year to date. If you look at the defense and government contracting sector, it's flat to up, right? That's as good of a real data point as I can give you to show you the stark difference between defense and government and other in the broader marketplace. That said, I don't think that defense and government runs up the same way in markets that are running up, and I don't think it declines the same way in markets that are declining. And so I don't think you see this as big a swings in valuation multiples. And there's a really well-established hierarchy. The bigger businesses get a bigger premium and get bigger multiples, and the smaller companies get smaller multiples, which is another driver for trying to grow your business. Now you got to grow it in the right places too. You can't just get big for the sake of getting big. I think that you'll see, while there are always examples in our marketplace of some outliers, and yes, like Rob said, everybody wants to get that outlier valuation. It may become a little harder just to get that kind of multiple, because I think the broader capital markets, things going on, do cast a pall across even our sector. And but I think you still have plenty of opportunity for value creation. I still think the model of, if you're small and you can grow and get to that next tier, is a great way to capture and create value, which suggests adding M&A to your strategy. The big players might see some pressure on their valuation multiples, but it doesn't go from a 15 multiple EBITDA to a 6 multiple. It might go from a 15 to a 13. So still pretty attractive valuations. And if they're buying smaller businesses at a 8, 9, or 10, they're still creating significant value once they add that to their portfolio of businesses. So hopefully I don't leave the picture. We're at some new peak, and we're going to reach new peak levels. I just think that the dynamics are such, and you can see it when you look at the public company participants in the government space relative to other markets. And the dynamics are a little bit different in our market, and that will hold valuations at some reasonable level that allows sellers to do well and allows buyers to do well.
Great, thank you. So I think we've shared a lot of really interesting thoughts, covered really some good topics for our audience. Maybe as a final question to each of you, we're sitting here from 12 months from today. We're looking back at the market. What are we going to be saying? What's going to be the theme that we missed, or what's going to be the event that happened that we were targeting and planning for? What's kind of your prediction over the next 12 months? Chris, let's jump with you.
Well, I'm gonna stay very tight to an area I know and avoid all of the other things that are going to be wrong by definition. Listen, I hope that in 12 months' time we're beginning to see sort of green shoots in terms of, I'll just talk about volume. I do think we're going to have a reduction in volume, the opportunity set back half of this year, probably into next year. And my hope is that, if I think back at, as bad as fall of 08 was, and how everybody kind of arms got real short and everybody kind of hunkered down, by the fourth quarter of 09, the M&A market was beginning to rev back up. And then, of course, we were off to the races really in 2010 and beyond. So, that was a particularly bad recession, obviously a particularly bad crisis that we faced. And we could argue about whether that has any bearing whatsoever on the potential that we might have of a macroeconomic slowdown today. But I think, and the other panelists have alluded to this, I just think there's still going to be supply and demand for the M&A market in a lot of industries. And while we might slow down from an opportunity set, my guess is by a year from now, we're starting to look around the corner and start thinking about the next set of opportunity. So that's my optimistic viewpoint of a fairly short slowdown in M&A activity.
I'm happy for the optimistic outlook. Rav, parting thoughts on your side, kind of the 12-month look back?
In similar fashion, and I'd say my wife probably says it best right now, this has been the year of uncertainty in many ways, and just feels like every conversation and discussion is well, I don't know, there's a 20% chance of that and a 10% chance of that. And what's the probability of this? And it doesn't matter what decision we're talking about, business, personal, other, like, can you even make a flight this summer without getting a delay? It's pretty uncertain, the world. And I'm hoping for just a little bit less noise in the system, right? That next year, some of this uncertainty is taken out. We've had a lot of just very volatile times, right? And if you can reduce some of that, the normalcy comes back. If you talk about, to Chris's point, the public markets, how much lower can valuations really go on an enterprise value basis? There's got to be some big public M&A that's going to step up and take some of this and clean up some of this stuff. Hopefully we don't see a world of just SPAC mania all over again, right? There's somewhere in between that's more healthy. But my broad view is that the world of uncertainty comes down, the volatility comes down a little bit, and that should allow for easier decision-making for everybody. And I think it's otherwise very difficult today. And hopefully that becomes just a little bit easier. So.
John, we have some pretty positive outlooks on our look back. What say you from your side?
Well, I guess I'll build on the uncertainty theme. I think the thing I would say is, unfortunately, probably a year from now, there'll be some new uncertain thing in our lives, right? And that, I've lived long enough now, from .com bursting of the bubble to the Great Recession to, 9/11 and a pandemic and the geopolitical situation we face now. And, it seems, my wife would probably say, when I lament the next thing about uncertainty, she would remind me, we see it all the time. And in that, for me and for us and for the companies we invest in, is you can't control those things. And so you just have to have good leadership teams, making good business decisions, do your best to grow and position yourself to grow in the right areas, and not let the uncertainty overwhelm you. And you can be as successful in times that have a lot of uncertainty around them as you can be in times where it seems like it's a little easier to make decisions. So, we feel certainly, like I said, long-term investors, long-term participants in the sector, not going to go anywhere. And, the ups and downs are not going to really change our model a whole lot, because we think long-term, our marketplace where we spend our time is a great market to be an investor in.
Great. I like where you are all thinking. Want to take this chance just to thank you, Chris, Rob, John. Appreciated the chance to talk with you this morning. You really enjoyed your insights and sharing how you're looking at the world today. So thank you, and thank you for all the people watching. Look forward to seeing you all again soon. Thanks.
Thank you.
Thanks for having us.